Good morning. It's Steve with PUG Stock Market Analysis, and it's December 22nd, 2025 here at the year end holiday season. I haven't put out a video for a while, so I thought I would just share with you some thoughts here at the year end of 2025. We've been tracking the S&P 500 in its super cycle 5 final wave up here, all the way going back to March of 2009, and that's when super cycle 4 ended, as we know, down here around 667 on the S&P. It's been quite a ride. We're already up here at, we got as high as 69.20, almost a factor of 10 increase from where we were, or a little more than a factor of 10 increase from where we were back in 2009. Pretty impressive. And in drilling down a little closer, we're actually in cycle 3 wave of this super cycle 5, which is C3. C2 ended at the COVID low in March of 2020, down here at 2192 on the S&P. And the first primary wave up of cycle 3 ended at 4819 in January of 2022. We got this significant primary 2 pullback down to 34.92 that ended in October of 2022. And ever since October of 2022, we've been in a primary 3 wave. We've been in a primary 3 wave that ended in February of 2025. It actually ended this year, right before the tariff tantrum. So that primary 3 wave carried almost the same equal distance as the primary 1 wave. It ended at 61.47, which was just slightly larger than P3 equal P1 at 61.19. So when that happens, when the primary 3 wave extends longer than the primary 1 wave, it allows the primary 5 wave to move as high as it wants to, because in Elliott wave theory, the only thing it's a hard and fast requirement is that the primary 3 wave can't be the shortest. So because 3 was longer than 1, it now allows 5 to be whatever length it wants to be. So after the tariff tantrum here in April of 2025, we dipped all the way back to 48.35, and we held this 50-month moving average. What is a 50-month moving average? Well, it's roughly a 4-year moving average, right? 48 months would be a 4-year moving average, roughly 12 months in a year. You see this kind of aqua line on my chart here, and look how important this aqua line is. If we look at this 50-month moving average, simple moving average, all the way back to October 2011, when we first came out of the great financial crisis, got the first primary wave up. Every time we pulled back, we've held this blue line. If you look at here in October 2011, February 2016, December 2018, the COVID, that was a COVID, that was prior to COVID. COVID low broke it here. Okay, so yeah, we violated it here briefly down to this 2192 in March 2020. Well, that was an extraordinary circumstance, as you know, with the economy being shut down. So we did break it, but we didn't stay down there. We actually closed that month higher. And then if you look at this primary 2 wave of cycle 3 back in 2022, we got down here and we tested it again at 34.92. And then even in the tariff tantrum this spring, we got back to 48.35, which tested it again, held. So what I'm saying here is that the 4-year simple moving average, or the 50 month moving average, is extremely important when you're in a like a super cycle wave like we have here, super cycle 5, right? So we're going to have these pullbacks these primary 2 pullbacks, these cycle 2 pullbacks, which we've seen, even primary 4 pullbacks, they're always tend to hold this 50-month moving average. So ever since the end of the tariff tantrum here in April of 2025, we've had a very, very, very strong kickoff to the primary 5 wave. Primary 5 is cycle 3. So my thinking, it's been this way for a while. I thought that the cycle 3 wave would reach roughly the 6.62 Fibonacci of the cycle 1 wave. So that's up here at 8150. So got a ways to go. We're approaching 7,000. So we still got maybe another 1,000 points on the S&P. I think it's going to be kind of jagged though a little bit, even though we have this strong burst, this major 1 wave of primary 5 of cycle 3, which I think might get up here to maybe 7,300 sometime this spring. I think that the last 1,000 points, if you will, up to the cycle 3 top, is going to be pretty jagged, pretty rough. We're going to probably burst out of here at the end of the year above the 69.20. We're trading today at 68.76. Make a new high early next year. But then I think next year, being a midterm election year, typically a weak year, you've had a couple of really strong years. It'll still be a good year, I think. I think we'll end higher than where we started. But I think there's going to be after we top out around 7,300, I think there's going to be a pullback. And we may pull back all the way to test the 6147 in this major 2 wave. Kind of just throwing it on a placeholder here, but it wouldn't be unusual for us to back test that. And then going into 2027, 2028, we'll get a major 3 wave higher, a little pullback in major 4, and then finally the major 5 of primary 5 of cycle 3. We'll get up here around 80, 81, 8,200, let's call it. I think that's going to occur sometime, early spring of 2028, the election year of 2028. And then, after that, there's going to be, after that cycle 3 top, there's going to be maybe a triangle wave, or definitely a consolidating type of wave for cycle 4, going out into maybe 2029, 2030, and then a final cycle 5 wave out here into like the 2033, 2034 time frame. And I think the cycle 5 wave could approach 9,000 and maybe higher. Okay, that's just some approximation based upon the pullbacks that I'm seeing along this general white channel trend line here, which is also going to be holding this extended 50-month simple moving average. So that's big picture. I've been charting this monthly chart. It's shown on my blog, PUG SMA.com. It's shown as a long-term view. You can click it right at the top of the blog. I've been showing that since this long-term view since 2009, where we had the cycle, super cycle 4 low. I've been calling for the super cycle 5 wave, much higher, back when everyone was panicking, running for the hills. And it's been holding. You can look at the 15-16 year history of my long-term view, and you're going to see that it's been pretty consistent. And we're getting here, in the last, we've been 15-16 years of doing this. I think we got another maybe 8 to 10 years till we get to the super cycle 5 top. And then, there's going to be some upheaval, but, that's a long way in advance. Let's not worry about it right now. So I just want to show a couple other things here. Let's drill down. If we look at the daily chart of the S&P, you can see this nice channel off this the 48.35 low back last spring during the tariff tantrum. And we've been holding this nice the 125 exponential moving average has been kind of important. This yellow line. Once we got above it in the early summer, we've been holding this yellow line. And when we had this pullback here to 65.22 recently, like early December, that very important 125-day exponential moving average held. And we had a little pullback here in the last week. we get down here to 67.20. I told everyone, I said, hey, you got to look at that. You got to kind of watch that 125 day. But I also said on the weekly chart, you got to watch another important yellow line, this 20-week EMA. I said, we got to hold that. I moved over to the weekly chart now, and it got a little scary there. We got down to 67.20. We were probably like 100 points above it. As soon as we got down there, though, I was bringing that up as an important level to watch. It's kind of being an early indicator, so we make sure we don't violate the 65.22 low, this minor 4 low. And sure enough, we held it. The very next day when we got to 67.20, we immediately rallied out of that hole, and been going up ever since. So it got us going. Again, we're in the primary 5 wave, but we're in the major one of the primary 5 of Supercycle 3. So I got this major 1 wave, as I mentioned, getting around 7,300 in the spring, maybe late winter, right? But right now, after we had this minor 4 low at 65.22, we got this first burst up for minute 1 up to 69.03. I thought we were going to go higher immediately. I was pretty optimistic that we wouldn't have this much of a pullback. We did get a big minute 2 pullback down to this 67.20. As I said, got a little scary there. But it was like a 50% retrace, because 67.13 was a 50% retrace. We got the 50% retrace. Very common of a wave 2. It panicked everybody. There's a lot of bears. I mean, the bears came out in force here. They're like, oh, look at this double top. We're going lower. We're going to break this 65.22. We're going to crash. I wasn't showing any alternate counts. I wasn't worried. I did want to mention, about the 20-week SMA and the 125-day EMA. And I says it's very important to hold those, and it would be an early warning sign if we broke those, and we might be breaking the 65.22, but it didn't. And there was enough fear built up, and the market, rallied higher, and we're almost back to that 69.03 level we hit for this minute 1 wave. And I would say during this Christmas rally, which typically the Santa rally begins on the 5 last trading days of the year, plus the first 2 of the next year, which basically starts this Wednesday and goes into like January 5th. I think we're going to be at a new all-time high. Like as we exit the Santa rally, we're going to be, if we go to the hourly chart, I think I got a 69.73, for the sub-minute 1 of minute 3. As I said, I think we're going to get up all the way up here around 7,300, but we're going to go up there in 5-minute waves. The first minute wave, the 69.03, the pullback to 67.20. We talked about the scary pullback. Now we're in a sub-minute 1 of a minor 3 higher. And the sub-minute 1, I think, has got us breaking the high here at 69.73. Probably that's the end of the Santa rally. Then be a little pullback for sub-minute 2. Then sub-minute 3 up here around 7,100, and minute 3 up here around 7,200. Look at this chart, this 60-minute chart. I mean, it couldn't be more beautiful, right? You've got this blue channel that's been holding for a long time, including this minute 4 pullback to the 65.22. But there's also this yellow line coming off the low here, the tariff panic low at 48.35. Look at this yellow line. If you draw this yellow line up to this minute 4 low we had there in November, you can see when we did get this scary pullback here from 69.03 to 67.20, what did it hold? It held both the up channel line, the blue line, and it held this diagonal line coming off the tariff low. And sure enough, we rallied right out of there. And it also was a back test. This is on the 60-minute chart. I think I was bringing this up. There's a bull flag when the market peaked in late October here at 69.20, and it dropped down to this minute 4 low this minor 4 low at 65.22. it formed a bull flag, right? It wasn't a big sell-off all at once. It was down, up, down, up, down. You know, so it forms, you know, what we call in technical analysis a bull flag. Basically, the market's flagging, it's consolidating. You know, it's there's the pole of the flag is this long trend, you know, trending wave all the way up here to the 69.20, and then it's flagging back like a flag on a flagpole. It's flagging back, but it's doing so in a jagged, consolidating way, corrective way. An Elliott wave, you know, wave fours are corrective. They're correcting this long uptrend of the minor three wave. And so that's typical and it's common. And this bull flag forms. And now look, when we back tested here to this 67.20, when the bears were coming out of the woodwork, we just back tested this bull flag. We undercut it a little bit. I thought we might have hit the low at 67.60. But then it kind of fooled us. It went up and it went back down and it undercut the bull flag a little bit to 67.20, but it held these uptrend lines, and then it's rallied strong, like 3 straight days of rallying, and here we are almost back at the all-time high again. So this bull flag, by the way, on the 60-minute chart, this first bull flag measures all the way out here to 73.18, which is, you know, where I project this major one of primary 5 cycle 3 top to be. So in the February, March, you know, late winter, early spring time frame. So we get that first bull flag measuring out there, but you also got this secondary bull flag, the one that, you know, got the bears all excited here when we dropped from 69.03 to 67.20. That measures out to like 7,100. So we got this first little, I got the first bigger bull flag taking us out here to 7,300, but we got this little shorter bull flag, which happens to be the minute 2 wave, measures out to 7,100. So like in January, we're going to get out to probably 7,100, that area, and then we'll flag again up in here, and we'll make this final push higher. So that's kind of what's going on. I can drill down here on everything's like beautiful. It's been holding really nice Elliott wave extensions, Elliott wave pullbacks. So again, this was a 50% pullback. This 69. I think I got a 5 on there. It should be a 6. 69.03 down to 67.20. That was almost a perfect 50% retrace, as I said. That's a typical wave 2. And now we're rocketing higher. This first burst out of here that's a sub minuet 1, because we're only looking at minuet 1 here up to 69.73. So this is sub minuet 1. Back down to 67.58 was a back test of this low. Gives about a 50% retrace. Now we're bursting higher in the sub minuet 3 of minuet 1, and I got us going up here at 69.13 in the next couple days. Today we've already hit, what do we hit here today? If I look at the top of where we've hit today, I think we're up almost, what do we got? Let's see. We got up to about 68, 78, right? So type that in here. So we're getting there. We're almost up to the 69.13, which is a 1.62 Fibonacci extension of the sub-minuet 1, and then we have a little pullback, maybe around. This is before Christmas, maybe a pullback a little after Christmas, and a burst higher into the end of the year. So, I mean, it's just tracking wonderfully. Everything is looking great. Oh, one thing too, you know, there's always indicators that like help us, you know. I mean, here's my blog, PUG Stock Market Analysis LLC. I mentioned, you could go back and look at this long-term view here. You can click on it. I mean, it goes back. I've got this going back to, if I scroll all the way to the bottom, we're down here in October of 2009, and look at these charts. I mean, and everyone is panicking at the devil's number 666 low in the S&P. I had us bursting higher, and I had you know, everyone was like, oh, it's just going to go higher and it's going to fail. No, so I've been doing this. This is 16 years. And there's a chart on here. There's a weekly, daily, monthly chart on here going back 16 years, and you could see everything I projected. I mean, it's all transparent. If anyone tells you they know what they're doing 100% of the time, they're wrong, they're lying to you. But I try to do my best, and I try to give a good big picture view to everyone. And I do give alternate counts when I think there's choppiness and we don't know exactly the direction. But I'm transparent on what I try to do. But we're right a lot of the time. We're not right all the time. Long term, you know, thankfully I've been roughly correct with this cycle 5 wave coming out of the 2009 low. So everything's going good. It's been a great year. The market's up 16-17%. It was up 20-something% the year before. It's always great if you're a bull and things are going higher. But what I wanted to say was, you know, there's always an early indicator, right? I talk a lot about the broader market, like the NYSE, right? My focus is always the S&P 500, but I do like to talk about the broader market. The NYSE, the broader cumulative advanced decline line. Look, you know, when we got up to 69.03, and then we made a new high. The market didn't make it made a closing high at 69.03 in early December, but it didn't make a new all-time high. The 69.20 didn't get breached. But the broader market NYSE advanced declining line, which kind of tells you what's happening under the hood, yeah, it made a new high. Okay, that tells me the S&P will eventually make a new high. Now it pulled back to 67.20. It's rallied all the way back to 68, 78. It's almost all the way back. Today, there's a good chance this NYSE 80 line is going to make a new high. Right? This is an intraday chart. It's already up 1% today. It's really close to breaking out to a new high above where it was when it hit 69.03, which was already higher than when it was at 69.20 back here. So the broader market is painting the picture. There's a lot of stocks advancing, a lot more stocks advancing than declining. When that happens, the S&P has no alternative but to follow. So the S&P will follow higher. It's being held back now because there's some technology stocks that are struggling, but it's rotation. People are rotating into financials. People are rotating into small caps. That's a healthy bull market, and that's borne out and shown here in this NYSE advanced decline line. So there's always something to look at that kind of gives you some clues where we're headed beyond just the wave counts, beyond just the technical analysis. I mean, I hope that helps you, explain a little bit what I'm thinking. It said it's been too long since I've had a chance to talk to everybody here on the channel. I do talk to my subscribers through the comment section every day. If you want to get on board for next year, if you're not part of the premium service right now, I go over these things every day in the comment section. I show advanced decline line charts. I show, talk about the moving averages, talk about key levels. If we violate this level, what will happen next with the count? I do that intraday to give people a feel for what I'm thinking and how the counts might change. I don't update the counts typically to the end of the day if I need to make modifications. So, but I try to give clues throughout the day, and I do that to try to help subscribers feel comfortable with what's coming and what I'm thinking. I appreciate all the business that people have given me over the last 16 years. I said it in the chat or in the comment section this week. I get the best subscribers. I don't have that many subscribers. I got a free, Twitter channel that I have. A few people come my way. I don't advertise. Got a lot of loyal people who've been with me, and I appreciate that. I appreciate them. I got the best subscribers. They ask intelligent questions. They don't panic. We get little pullbacks. I don't get a million comments about, oh my God, the market's crashing. What do I do? What do I do? No, this is technical analysis. We have to be calm, cool, collected. We have to look at the data in front of us. If the data changes and it's telling us a different story, then we will modify the wave count. We will modify what we're, the forward projections. But we don't panic on this channel. My subscribers trust me. They've been with me. A lot of people have been with me the full 16 years. A lot of people have been at least a decade. This stuff is thought out. I put it there for you to use. It's data. There's lots. I know you're getting data from a lot of different sources. I'm not the only technical analysis. I don't do fundamental. I know everyone's using a lot of different tools for their trading, for their investing. I'm just one of them. But I think I offer this service at a reasonable price for everybody, and I hope you appreciate it. I definitely appreciate you as customers, and I want to thank you. And everyone have a happy holiday and enjoy your time with your family and friends. And we'll talk to you in the new year. Bye for now.